think the role of a mortgage broker is to help you get a loan. And it is. A big part of our role is to help you navigate dealing with the banks and getting the loan you need. But a big part of our role is also helping you then pay down that loan and saving as much money as possible over the life of that loan. Now, this is an important part of the role because with rates quite high, as they are, typically around 6%, you actually will pay more in interest than you will in principal over the life of a standard 30-year loan. As an example, if you take a $500,000 loan out today, 30-year principal and interest term at a 6% interest rate, you will pay approximately $579,000 in interest over the life of that loan, which means that $500,000 loan actually cost you $1,079,000 over that 30 years. Now, there's a lot of levers that we can pull that help reduce the overall cost of that loan. And I feel that part of our role is to educate clients in how to use those levers and how to minimize that overall cost. However, I think before you start talking about these levers and before you start talking about the ways that you can save money, I think the key starting point is actually understanding how the loan works, which will then allow you to better understand why these levers do what they do and how they're going to save you money over the long run. So, starting point, we have a real life example of that loan. That was a $500,000 loan with a 6% interest rate over 30 years. Now, the monthly repayments on that loan, $2,998. Now, over time, your breakdown of that loan in terms of the proportion that's paid towards principal versus the proportion that's paid towards interest slowly moves in your favor. But it's important to understand that at the beginning of that loan, it's not great. The first repayment of that loan, you will pay approximately $2,500 of your $2,998 goes towards interest, and only about $498 goes towards paying down the loan. Now, month two, you pay about $2,498 in principal, interest, and about $500 in principal, and slowly over time, that moves more and more in your favor. But this is why you may notice that if you've had a loan for 1, 2, 3 years, it feels like you're paying a large amount every month, but you're not making much of a dent in the loan. And the reason for that is because the vast majority of your repayments early on in the loan are going towards paying down that interest. The reason why this changes over time is that every month you are charged interest, but it's calculated daily. So what that means is every day they look at the balance of your loan on that day, and then if any offset or redraw, and they charge you interest based on that. Now, over the life of the loan, even if it's moving quite slowly, you're reducing the amount that you pay down. You're reducing the amount of principal that you owe, which therefore reduces the interest that you are charged. Now again, it moves quite slowly, but it slowly snowballs. And by approximately year 19 and a half, you're finally paying more than half of your repayment towards reducing that principal. Now that's quite depressing, to be 19 years into a loan and still have more than half of your repayment going towards interest. Now, the good news is there's a lot of levers that you can pull, but the key thing is understanding how this works, because that will allow you to better understand how these levers work. Now, the main levers we look at are obviously a cheaper interest rate, because if you've got a cheaper interest rate, you're going to pay less interest over time, and therefore the same repayment would lead to faster pay down of your principal. The second one is simply additional repayments. So if you have a repayment of $2,998 and $2,500 of that is going towards interest, if you put an extra $100 a month towards that repayment, all of that $100 goes towards principal, which therefore starts to snowball that effect and have you paying off that loan quite substantially faster. The third, and probably I think the most exciting option, is offset accounts, how to use them optimally, because as a reminder, your interest is calculated daily based on the net value of your loan, which is your loan balance minus any funds in redraw or eligible offset accounts. So those are the levers that we can pull. But again, I think the most important point is understanding how they work, how the loan works, and therefore what changes this makes to the repayments.